Well, hello friends. Last week in my video, we discussed whether bulls were going to be likely to be able to revive sentiments in the markets. And I gave you a conditional answer. The condition being that the Nifty 50 in the spot segment must trade above the 24,750 mark. That did not occur. And we are going to see in this video whether the last final week before New Year sets in, at least the first two trading sessions of the week before New Year 2025 sets in, will the Santa Claus rally persist and how bulls are placed in the week ahead. And on your screen right now is the weekly market roundup. And what you are seeing is the Bank Nifty led the way up by rising a little more than the broader based Nifty 50. This was more to do with short covering and, of course, the usual expiry related process of rollovers. The US dollar index continued to rise a little, but it was the Indian rupee which hit a record low against the US dollar, and that is going to be the prima donna or the big worry in the absolute near term. I told you in this video on the US dollar about what to expect when the rupee starts to kind of weaken against the dollar, how it will impact your household budgets, inflation, your investment and trading strategy. I do hope you've studied this video well, along with the cost of funds theory that I have been imploring you since many months to understand. So let's jump right back into the weekly market outlook. And what you're seeing is that a marginally strong US dollar index failed to contain the upthrust in gold and silver, which I have been telling you are likely to be bullish for 2025 and even beyond. Crude oil saw a little bit of short covering on worries about supply chain disruptions. Natural gas, what you're witnessing is an apparent, now I'm using the word apparent here. This is where rookies make the most amount of mistakes. During winter months, when demand is expected to be high, the cost of carry is unduly higher, which rookies mistake for a breakout on the charts. And now that we are getting closer to the summer months, starting from the vernal equinox, you're going to see backwardation, which means the forward months are likely to see the price lower than the current month. So you are basically likely to hear a lot of noises about how the chart has broken down. This is cost of carry and not breakout or breakdown. The Indian 10-year benchmark bond yield fell ever so slightly. And that basically means that the bond price went up marginally. And that was one of the reasons why the Bank Nifty has been buoyant. NSE market capitalization gained very slightly. So that basically tells you that broader markets were not half as bullish as the headline indices were. MWFL fell, which is a routine matter ahead of expiry. And what we saw is the US indices basically gain on a week-on-week basis, and that provided some amount of tailwinds to our markets. Friends, I now come to the Bank Nifty divided by Nifty 50 ratio chart. Why is that important? Because of the way our indices are constructed. Do remember, in financial markets, nothing happens without a reason, and the reason is invariably financial in nature. So with over 34% weightage in the Nifty, banking and financial sector stocks are a swing sector. And what you are seeing on the ratio chart on your screen is that the price has attempted to go higher. Where the ratio chart price is concerned, it attempted to go higher, could not sustain higher levels for the third consecutive week in a row, and is threatening to break down below the downward sloping trend line. I told you I'll feel very comfortable holding a bullish view if and only if this ratio chart was to trade above 2.35, if not 2.45. Now, the last 3 weeks have been extremely testing where patience is concerned of an average retail trader. Friends, the ratio chart done. I now come to our in-house indicators. I start with MWPL or market-wide position limits. This is the extent of positions utilized by traders as a component of the total limits allowed by SEBI. Now, the usual post-expiry dip in the MWPL has seen a reading of 24.45, and that is a marginally higher level as compared to last month's post-expiry low of 23.71. So what it tells you that risk appetite was marginally higher. Now, it still remains lower than what it was in the months prior to this. So normally ballpark was that post-expiry declines would be around 30 to 31%. What you are seeing is a noticeable decline thanks to increase in lot sizes, margining, peak margin systems, intraday mark-to-market systems, etc. And we need to watch this MWPL figures very, very clearly and closely. I update this on a daily basis on my social media account, so do make it a point to connect with me there. Now, friends, I come to the index and stock futures turnover. This is the total of all 4 trading sessions of the week. Now, the fact remains that a lot of this turnover rise in stock futures indicated as a red line is because of the expiry. Traders tend to kind of close their positions in the expiring month and create the same position in the next month. That results in dual turnover, which is why the turnover appears to have gone up. But ironically, index futures turnover has fallen, maybe due to the 4-week trading week, 4-day trading week that we had thanks to a holiday on Christmas. The fact remains that participation levels are coming down. Now that presents us with a risk of the bid and offer spreads widening. Now, bid and offer spreads are the difference between the best buyer and the best seller, and the wider the spread, the lower is your take-home profits. This would be a worry in the week ahead. Now, friends, I come to the advanced decline ratio after the price. It's the most leading indicator out here. What you are seeing is that the Nifty from prior weeks 4.5% decline has come to almost 1% of gains last week. But the advanced decline ratio, which is an average of all 4 trading sessions of the week, has risen ever so marginally from 0.56 in the prior week to 0.84. Now, which means for every 100 losers, last week there were 84 gainers only. That doesn't really imbibe too much of confidence. If at all bulls want to be in the driver's seat, the advanced decline ratio must stay above 1.0. Do watch this figure, please. As usual, I update it on my social media accounts every day. Now, friends, the next one is the basis. Basis is nothing but the premium or discount prevalent in the futures compared to spot. Do remember, like the options premium, basis is also time sensitive. The closer you come to expiry, the smaller is the basis. Now, this is the beginning of the month when the January futures series have opened for trade. So obviously, the basis is much higher. The premium is much higher. Now comes the tricky part. Is the Bank Nifty basis of 413 rupees and Nifty 50 basis of 179 rupees sustainable? Well, frankly, statistical weight of evidence seems to tell me that it's not sustainable. In this week itself, I would expect the basis to come down fairly noticeably. That would mean traders who are betting on ratio trades, Nifty versus Bank Nifty, or they are basically taking delta neutral strategies, will have to adjust accordingly. Now, friends, I come to the impetus. This is our in-house indicator. You've trusted it for almost 4 years now. And what you are seeing is that the rallies in the indices last week is accompanied by lower impetus. Lower impetus would mean lower buying momentum. Not a great sign. Now, this impetus has been adjusted pro rata for the fact that it was a shorter week by 1 trading session. But in spite of that, the impetus reading is lower. That means higher levels might just see very tepid or very lukewarm buying support. I would have wanted a lot more buying if at all the upthrust is to continue. Can things change? Yes, of course they can. We will need to monitor the advanced decline ratio, the traded volumes, MWPL on a day to day basis. Don't worry, I've got you covered. It's all there on our social media accounts. Now, friends, I come to our in house indicator, the lift, weight, thrust, drag indicator. And what we are seeing is that the Nifty has logged 0.96% gains, but the lift, weight, thrust, drag indicator is still in the minus. Although in the prior week it was minus 0.43, it has climbed marginally, but it is still minus 0.21, which means at higher levels, fresh buying support is likely to be very, very cautious, very, very guarded. Hey, if at all you want the index to hit a new high, I would want the price and the LWTD to rise in tandem together. This is a weekly chart. Can things change on the daily basis? Yes, they can, which is why I update this indicator also on our free social media accounts. Start with the Telegram channel. My contact coordinates are at the fag end of this video and in the pinned comment below this video. Our in-house indicators done. I now come to the bond market, and what you are seeing is a very, very marginal decline in the Indian 10-year benchmark bond yields. But what I told you was that I would expect, I nurse a contrarian view. I'm not expecting rate cuts. I've put up a huge amount of opinions, editorials on our Telegram channel, first, foremost, and always, because that is one social media platform which allows me to upload PDF files, Excel sheets, working computations, etc., real time tick by tick, end of the day codes for the indices for you to basically incorporate into your in-house trading systems, statistical trading systems. So I've written a lot about why I expect market expectations of aggressive rate cuts to be belied or not met. So I'm going to keep the powder dry at least in the week ahead where gilt funds are concerned, as well as the 10-year benchmark bond laddering is concerned. Friends, the bond market's done. I now come to the bank Nifty, which stole the limelight and stole the thunder from the Nifty 50 itself. It gained 1.09%. And as you can see on the daily chart on your screen, it fell on 3 out of 4 trading sessions. Price is below its month-long moving average, which itself is sliding lower. And therefore, the absolute near-term outlook seems to be marginally nervous. The bearish gap that this index left on 12th of December remains unfilled. So overhead supply will persist. What is overhead supply? It's long positions which are trapped at higher levels, who are waiting in the wings to sell as soon as break-even prices come. So that overhead supply can limit the upsides. Upsides will be possible only after all that overhead selling is absorbed, which means that bulls must keep the bank Nifty trading persistently above at least 52,500 on a closing basis before bulls can be said to have regained some of their initiative. Let's now go to the weekly chart, and it shows a small bullish candle which is entirely contained within the prior week's bearish power candle. This is called an inside pattern or an inside formation. It indicates a pause before the next move begins. It means indecision, pausing, fatigue, and the traders trying to make up their mind. Now the price is precariously poised at its 25-week exponential moving average, which is a proxy for a 6-month holding on cost of an average bull. So the medium-term outlook is also tentative for now. Friends, the week ahead being a week, the final week of the calendar year, I would say trade light and maintain tail risk hedges, as I've explained to you in this video. And even after you're trading light, you can basically wait for bigger price moves, as I've explained to you in this video ahead. All the hyperlinks are in the pinned comment below and in the description below this video. Do make it a point to check these out. Now, in the week before last, this index was number 3 on the most volatile counters list as per statistical beta rankings I maintain in-house. Status quo maintained, ranking is still at number 3. Now, last week I estimated a range between 52,575 on the upside and 48,950 on the downside, which held perfectly well. Not as much as our accurate reading, but because the markets themselves were in a fairly narrow, tight range. In the week ahead, I estimate a range between 53,125 on the upside and 49,500 on the downside. And in addition to this range, do watch the daily, weekly, and monthly pivots that I update on our free social media accounts, particularly my Telegram and WhatsApp channels. Friends, the Bank Nifty done. I now come to the Nifty 50, which trailed behind the Bank Nifty by gaining 0.96% on a week-on-week basis. As you can see on the daily chart on your screen, it gained on only 1 out of 4 trading sessions last week. All 4 trading sessions ranges were contained within the range of Friday the 13th last week. Now that's a classic inside formation. The price remains below its monthly average, which itself is pointed downward, so the short-term outlook is negative as of now. The price is below its bearish longer time frame head and shoulder pattern, which is indicated as a red neckline, and also below its failed bullish inverse head and shoulder pattern, which is indicated as a blue neckline. That means the near-term outlook still remains under pressure. Do remember what I told you about overhead supply when I discussed the Bank Nifty. The same logic applies here. Let's now move to the weekly chart of the Nifty on your screen. And what we are seeing is that the price is below its 25-week exponential moving average, which itself is turning lower. So the medium-term outlook is tentative at best for now. My reading of the situation remains the same as it was in the last fortnight. 24,750 level is something that the bulls must overcome before I would start nursing bullish hopes out of my short-term trading regimen. Now, being a end of the year week, volumes may be lower, spreads may be wider, so prices can make exaggerated moves on a little bit of buying or selling nudges by algorithm-based traders or high-frequency trading desks, and that could be reflecting on the options premia also. So options traders are likely to see a mad week, possibly. It'll either be too volatile where your implied volatility will go through the roof, or it'll be frustratingly insipid and dull and lifeless. What will happen is something we'll know when the market opens. Friends, in the week before last, this index was number 8 on the most volatile counters list that I maintain in-house. It slipped 3 notches to number 11, which is a good sign because volatility going down means a retail trader has less of stress when trading on a short-term basis, particularly intraday basis. So friends, last week I estimated a range between 24,300 on the upside and 22,850 on the downside, held perfectly well. No real credit goes to our estimation, but because the market ranges themselves were narrow. Now, the coming week is estimated to have a range between 24,525 on the upside and 23,100 on the downside. In addition to these ranges, do watch the daily, weekly, and monthly pivots that I share with you on our in-house social media platforms. Also, don't forget to check out our pivot tutorial video as to how you can use our pivot points to laser precise your entries and exits and also increase your profit per trade. Friends, I now come to the last bit of statistical analysis wherein I discuss the retail risk appetite as indicated by the 4 segments of the derivative space. On your screen right now is the weekly chart where the index futures turnover contribution has gone down by 2 basis points, indicated as a blue line. Stock futures turnover contribution went up by 7 basis points, indicated as a red line. Like I mentioned to you in the volume indicator earlier, this could be because of the expiry. Traders are squaring up their December positions and reinitiating them in Jan. so a higher turnover is logged. Where options are concerned, they are relatively a lot less volatile and demand a lot less money in span margins and options premium if you're a buyer. So the heaviest amount of turnover contribution has come from the lowest risk, lowest margin instrument, that is the index options, which saw 133 basis point increase in turnover contribution, shown as a green line. Stock options turnover fell by a whopping 138 basis points, indicated as the purple line. So net friends, I would say that risk appetite fell very sharply. Now friends, I come to my own trading strategy for the week ahead. I would trade small because volumes are likely to be very limited. I would observe more and trade less. Theta decay in the interest rate sensitive sector continues to be the backbone of my trading strategy, and my focus will continue for two-way trading, long and short, where public sector undertakings, particularly public sector banks, oil marketing companies, defense stocks, power, logistics, and energy stocks are concerned. I will add the heavy commercial vehicles and the passenger vehicle space in my watch list, because interest rate sensitives, like I said, are likely to be in the limelight with larger price moves. And the volatility is something that short-term traders like. Now, I'm keeping my powder dry, like I said, in the debt markets, and I'm awaiting better opportunities, which I'm fairly certain will come where rates are concerned, yields are concerned. So I'm keeping a few check leaves spare in my checkbook. Oil and gas prices are making expected cyclical moves. Do remember, this is winter, and therefore my strategy of theta decay on both the energy counters remains in place. Metals are likely to see a range-bound trade in the final week of the calendar year. So metal mining stocks may also be somewhat range-bound. I continue to stay bullish on the very long-term basis in bullion. And my concern, like I mentioned in this video about the US dollar, is that the rupee has come to 86 to a dollar, and we might just have some amount of dark clouds on the horizon of market sentiments because of this. Unfortunately, forex trading is banned for an average retail trader like you and me, so there's little we can do about it, but we can definitely place quasi positions by taking positions in bullion or in interest rate sensitive segments, which of course are likely to feel some more heat, which I have explained very well in detail in my Telegram posts. Now, if there are any more ideas, I would be very happy to share them on our free Telegram and WhatsApp channels. Do prioritize subscribing to my free Telegram channel. That's where I put up all our reports and opinions. Friends, I wish you a very happy new year ahead in advance. And before I sign out from this video, a reminder to subscribe to my channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know what you think about my work and how I can help you better by recording videos on areas where you need more clarification and help from me. Also, friends, a humble request to share my video with as many of your friends, family, social media groups, WhatsApp, Telegram, Facebook, LinkedIn, Twitter, etc. so I can reach out to a wider audience and spread the cult of knowledge-based investments and trading. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a very profitable week ahead. Thank you. Bye-bye.